Welcome back. In part 1, we mapped out the macro architecture for both our active alpha strategy and our passive tax loss harvesting engine, and we discussed why a poisoned covariance matrix can cause a convex optimizer to blow up our portfolio. It is now time to open the black box. So today, we're doing a deep dive into the structural logic of a production-grade risk engine. So let's get straight to the architecture. You can see here we have the factor engineering engine in purple at the very top. So building X is the very first step in engineering the covariance matrix, and in fact this is our very first implementation step in this series. But since we already briefly talked about it, and in the interest of time, I'm going to skip discussing it here again and go straight to the main event, which is the risk engine itself. Now, today I don't want to dive into every mathematical detail that you see on this diagram. What I really want to do is walk through the structural logic of the engine and discuss why this pipeline is separated into 3 distinct phases, and maybe provide some intuition for architectural decisions we make as we go through this pipeline. So inside the risk engine, first we have the laboratory for historical calibration at the top in blue. Second, in the middle, we have the daily production engine for real-time forecasting, which I have in orange. And finally, we have the denoising and assembly layer at the bottom in green. So let's start up here with the laboratory phase. This is where we process large amounts of historical data offline to calibrate the structural inputs for the live system downstream. So we have the factor exposure matrix X coming from the factor engineering engine at the top. So the very first step in our risk engine is running a sequence of historical cross-sectional weighted least squares regressions of stock returns on those factor exposures. These regressions will give us 2 core outputs: a time series of baseline factor returns, and for each stock, a time series of baseline specific residuals, UT. And by the way, if you're coming from academia, this is probably the part that looks most familiar to you. In empirical asset pricing research, once we estimate these factor returns, we then apply some time series estimators such as moving averages to forecast risks and expected return. In production, however, we do a little bit more work, just a little bit more work before trusting these numbers with real capital. As you can see, beside the baseline returns, the laboratory also produces a Bayesian shrinkage parameter called Q. So we'll come back to the mechanics of Q later when we discuss the specific risk track below. But for now, the important point is that the laboratory isn't just estimating risk. It is calibrating the defensive mechanisms that keep estimation error from propagating through the rest of the system. More on that later. So as you see on the diagram, the outputs from the laboratory phase flow directly into the daily production engine, which is where the architecture begins transforming historical estimates into live risk forecasts. Now, notice that inside the production engine, the architecture immediately separates into 2 independent tracks. The upper lane models the factor covariance matrix, which is a K by K factor level matrix called F, uppercase F, while the lower lane independently forecasts the asset level N by N diagonal specific variance matrix delta. Now, focusing on the factor covariance matrix, remember, back in the laboratory phase, we extracted a historical time series of factor returns. So the objective here is straightforward. Given the evolution of those factor returns through time, we want to forecast the next period factor covariance structure. So we have the historical factor returns for example, value and momentum. And now, standing at time t, we want to forecast the variances of these two factors and also their covariance at time t plus 1. Now, the naive way to do this is to estimate f using a single uniform moving average. But here's the problem with using a single uniform moving average when forecasting the factor covariance matrix. The matrix becomes either too slow during volatility regime shifts or too reactive to transient market noise. And this creates one of the central engineering trade-offs in risk modeling. You want the model to respond quickly to changing market conditions, but at the same time, you want enough stability in the system to prevent the optimizer from constantly churning your portfolio based on transient noise. And sure, there are ways to suppress this flicker downstream post-optimization. In fact, as you can see, I have included post-optimization smoothing in the active engine. We can dampen trades, apply moving averages to target weights that the optimizer spits out, things like that. Or we can even dampen signal flicker in the alpha engine, as I showed you earlier. But ideally, we want stability to emerge primarily from the covariance architecture itself, not from patching unstable outputs post-optimization. So going back to the risk engine, fundamentally this entire phase is about finding a balance between responsiveness and structural stability. Let's look at how we solve this and find this balance. We are going to use the fact that any covariance matrix can always be reconstructed from two separate pieces, correlation and volatility. So instead of modeling the entire covariance structure with a single decay rate, we explicitly split the factored covariance into two separate components, factored correlation and factored volatility. This will allow us to use a slow half-life for correlations to stabilize the structural relationships in the market, and a fast half-life for volatility so the system remains responsive to shocks. So the intuition behind this structural separation is the following. Correlation defines the shape of the market or the structural geometry of the market. How, for example, tech moves relative to utilities, how financials move relative to energy, or how different style factors move relative to one another. And that structural geometry tends to evolve rather slowly through time. So as a result, for correlation estimation, as you can see here on the diagram, we deliberately use very long look-back windows, something like 500 trading days. And this is because here we care much more about preserving a stable, well-conditioned covariance structure than we do about reacting to short-term noise. Because correlation is about the structural geometry, and the structural geometry doesn't react quickly to short-term noise. And mathematically speaking, using a long window keeps the system statistically stable because our sample size t remains much larger than k, which is the dimension of our factor covariance matrix. Volatility, on the other hand, defines the scale of the market. It is the quantity that most directly reflects panic, and panic can happen and spread and explode overnight. So we model volatility using much faster decay rates, allowing the covariance matrix to rapidly expand during market stress. Now, any experienced quant will immediately point out that during a crash, correlations go to 1 and everything starts moving together. And that is true. So how do we settle this with using long look-back windows when modeling correlation? This is because that is a short-term effect. A sudden liquidity shock doesn't mean that, for example, the fundamental business models of tech and utilities have become permanently identical all of a sudden. If we allow the correlation matrix itself to adapt too quickly to panic, then the optimizer starts learning false structural relationships based on transient market noise. And that is extremely dangerous because then the optimizer will begin constructing permanent hedges from temporary market dislocations. So, Instead, we intentionally keep the correlation structure slow and stable, rely on fast volatility dynamics, together with the next layer of the system, which is our volatility regime adjustments to absorb the shock. So for the VRA, as you can see, we calculate daily cross-sectional bias statistics. And by the way, this is the same metric I briefly referred to earlier when I was talking about the feature factory. So we calculate daily cross-sectional bias statistics to generate regime multipliers that instantly scale the covariance structure. And because the VRA acts as a uniform scalar multiplier across the whole matrix, it scales up the variance while mathematically leaving the underlying correlations entirely untouched. And we can write down the correlation formula, and it's evident that it doesn't change when we scale it using the VRA. So this allows the optimizer to respond to a crash on day one without corrupting the long-term structural geometry of the market. By now, we have covered the upper track of the daily production engine forecasting the factor covariance matrix, but that is only half the battle. Down here in the lower track, we also have to forecast the specific variance matrix, which is our diagonal n times n matrix called delta. Unlike the factor covariance matrix, which is built from a relatively small number of systematic factor returns, a specific risk is fundamentally an asset-level problem. So we'll discuss the theoretical underpinnings of the factor model frameworks in future videos, but within the factor model framework, specific returns are assumed to be orthogonal to factor returns and uncorrelated across assets. That means we can't estimate a specific risk from the factor structure itself. Instead, we have to estimate it directly from the historical time series of each stock's specific residuals that we generated back in the laboratory phase. So naturally, we begin with a standard exponentially weighted moving average forecast on those daily specific residuals. But almost immediately, we run into another production issue, which is market microstructure noise. So for illiquid stocks that don't trade as often, issues like bid-ask bounce, stale pricing, and asynchronous trading can make the observed specific return series look very different from the underlying economic process. These effects introduce serial correlation and distort naive volatility estimates. So before doing anything else, we apply Newey-West adjustments to account for that serial dependence and produce a more stable volatility forecasts. This is going to be our baseline time series estimation for specific volatilities, but we are not done yet. Because even after this adjustment, pure time series estimation is still dangerous. What happens if a stock is a brand new IPO with very little trading history? What if it's a micro cap that has barely traded for several days and mathematically appears almost risk-free? Or on the other extreme, what if a temporary event causes the time series estimate to spike to an unrealistically high level? So these are the problems that still exist, and because of these, we cannot use pure time series estimation. Now, as we discussed earlier when looking at the Woodbury identity, extreme errors in specific variance estimation becomes very dangerous once the optimizer starts inverting the covariance structure. So the question becomes, how do we stop these estimation errors from propagating into the portfolio? And this is where the architecture deploys two separate defense mechanisms, both of which I think are particularly elegant. So first, for stocks with missing or unreliable history, we deploy what we call a structural forecast. We already have the factor exposure matrix X at our disposal, so we can use the healthiest stocks in the universe to estimate the relationship between firm characteristics and specific risk. So conceptually, what we are asking is a very simple question. Based on today's market, how much do characteristics like size and industry explain idiosyncratic volatility? Now, you might notice something that looks a little strange and suspicious here. The entire factor model framework assumes that specific returns are orthogonal to factor returns, right? If that is true, how can we use factor exposures like size and industry and momentum to help predict specific risk? The key distinction is that orthogonality tells us something about return co-movement. It doesn't tell us that volatility itself is unrelated to firm characteristics. And here, we aren't modeling specific returns on the left-hand side. We are modeling a specific volatility. So there's no contradiction. But let's set this important distinction aside. We will come back to it when we derive the covariance structure itself. But going back to the pipeline, we estimate those relationships cross-sectionally and then use them to generate a structural volatility forecast for the rest of the universe. So what we are doing here is that we're going to use the healthy firms, the firms with trading history. We're going to use those in a structural equation so that we can find the relationships between firm characteristics and a specific risk. And then for unhealthy stocks which don't have trading history, we're going to use these structural relationships to predict their specific variance. And then, as you can see here, we use a data quality dial like gamma to blend the raw time series estimate with the structural forecast. So stocks with long, reliable histories lean heavily on their own observed data, so for them, gamma will be close to 1. But for newly listed IPOs or thinly traded microcaps or in general securities with missing or unreliable observations, gamma moves towards 0 and the model gradually shifts towards the structural estimate. So that's our first line of defense, protecting the system from broken or incomplete data. But even for stocks with perfectly good data, we still have a second problem. Extreme volatility estimates almost always mean revert out of sample. A stock that appears unusually quiet today often turns out to be riskier than the historical estimate suggests. Similarly, unusually high volatility estimates frequently normalize over time. Now, let me emphasize this again. Because the optimizer ultimately inverts the covariance structure to arrive at portfolio weights, the target portfolio weights become related to delta inverse structure. If a naive volatility estimator underestimates the specific risk of a stock, that small error gets inverted and can explode directly into portfolio weights. So, naive daily volatility estimates simply aren't stable enough for production. And this is exactly why, back in the laboratory phase, we calibrated our Bayesian shrinkage parameter Q. Using this parameter, we segment the universe into peer groups based on market cap size deciles and compare each stock's forecasted volatility against the cap-weighted average volatility of its peer group. This will create the baseline for us. If a stock in that size bucket drifts too far away from that baseline, the shrinkage procedure gradually pulls the estimate back towards the group average. So conceptually, what we are doing is imposing a statistical skepticism on extreme forecasts. The farther an estimate moves away from what we would normally expect for a stock of that size, the more evidence we require before allowing the optimizer to trust that estimate. This will dramatically reduce the likelihood that the optimizer will mistake sampling noise for a genuine diversification opportunity. And finally, just like the factor covariance matrix, we apply an independent specific volatility regime adjustment. Now, this is important. Note that we are keeping the VRA parameter for a specific risk independent from the one we use for factor covariance, because this allows the system to distinguish between broad macro shocks like the 2008 global financial crisis and localized idiosyncratic panics like the dot-com bubble collapse of early 2000s. Now, at this stage, the specific risk side of the model is in good shape. Now, you might think after applying split half-lives and volatility regime adjustments in the daily production engine, the factor covariance matrix is also stable and ready to be handed over to the optimizer downstream. We are closer, but not quite there yet, because at the end of the day, this is still a sampling covariance matrix, and sample matrices inevitably contain spurious correlations. These false correlations make certain positions or combination of assets appear far more diversifying in sample than what they actually are out of sample, effectively creating what I like to call risk-free wormholes for the optimizer. If we don't scrub out this statistical noise or sampling noise, the optimizer will happily and aggressively exploit these fake diversification opportunities, dangerously over-leveraging the portfolio. So we solve this analytically using random matrix theory. First, we decompose the covariance matrix into eigenvectors and eigenvalues. So, eigenvectors define the structural directions of market movement, and eigenvalues measure the variance explained along those directions. Now, the idea is some of these eigenvalues are real, meaning they represent true economic signal or information, and some are just pure noise. But here's the question: how do we actually know which one is real and what's just finite sample noise? This is where we bring in the Marchenko-Pastur threshold. What this does is gives us a strict mathematical cutoff. Anything above this line, that's true economic signal, and anything below it is just a statistical static. So what we do here is, after calculating that Marchenko-Pastur threshold, we take all those tiny unstable eigenvalues below this threshold and we just average them out. So we're essentially flattening the noise floor. Once that's done, we rebuild the covariance matrix using those cleaned values alongside the original eigenvectors. And this final detail is extremely important. By preserving the original eigenvector structure, we retain the structural geometry of the market and preserve the original variance structure of the matrix while systematically removing optimizer instability caused by spurious correlations. In effect, we aren't changing our map of the world. We are simply removing noise off the lens before handing the map to the optimizer. All right, so we've made it through the three core phases of the risk engine. At this stage, what we are left with is a stable denoised factor covariance matrix F and our stabilized specific variance matrix delta. So in theory, as we have it here in the structural assembly box, we could now assemble the full n times n covariance matrix V and pass it directly to the optimizer. But in production, we want to avoid doing that. As we've already discussed, V is a massive asset level n by n matrix. repeatedly inverting it during live optimization would be computationally prohibitive. So instead, we preserve the structural factor model and keep X and F and delta as separate objects. This allows the optimizer to exploit the Woodbury matrix identity, reducing the inversion problem from a large asset space inversion to operations involving inversions of the much smaller k by k factor covariance matrix and the diagonal asset level delta matrix, for which the inversion is trivial because it's diagonal. This single architectural decision massively improves our system's computational efficiency. So we have a robust risk engine that the optimizer now can deploy with high speed. Are we ready to hand this over to the optimizer? Before we ever let this covariance matrix or its components touch live capital, we run it through a full risk audit. We track what's called the rolling bias statistic. So basically, we take the portfolio's actual realized volatility and then we divide it by the volatility our model forecasted. This is basically a risk model backtest. If we have done our jobs right, if the denoising pipeline and the volatility regime adjustments are all dialed in, that ratio should anchor tightly to 1 no matter what macro regimes we are in. We only deploy the matrix to production once we mathematically prove the optimizer is not hallucinating risk-free returns from statistical noise. So we now have a stable denoised factor covariance matrix and a stabilized specific variance matrix. We have passed the risk audit and we're ready for production. But a map needs a navigator. So in the third and final part of this architecture review, we're going to deploy this risk engine. We'll feed it into our active engine to maximize the information ratio of our proprietary NLP financial constraint signals and into our passive tax loss harvesting state machine to execute tracking error constraint tax alpha. We'll also explore the absolute frontier of these architectures. I'll show you how we upgrade the passive decision node with a reinforcement learning supervisory controller. We'll tackle the hardest problem in retail direct indexing, which is the tracking portfolio problem, showing how we manage cardinality constraints by either decoupling selection and sizing through covariance-weighted clustering or by elevating continuous QC-QP solvers to mixed integer quadratic programming. And for the active engine, we'll explore replacing classical linear factor models with tree-based machine learning and deep autoencoders. The risk engine is built. Now it's time to deploy it. So I'll see you in part 3.